On June 18th, a leading technology integrator reported earnings, and the resulting market shock sent a wave of panic through the global consulting sector. Over the following week, my inbox filled with messages from colleagues and clients. They expected one of two responses, either a defense of the firm's current strategy or a concession that the consulting industry was sliding toward irrelevance. I gave them a third answer. The shock we see is a forcing function, compelling enterprise clients, tech companies, and integrators into a level of cooperation they have never attempted before. For the last 3 years, these three groups have played an adversarial game. At the negotiating table, the client, the vendor, and the integrator each optimized their own margins by squeezing the other two. That game has reached its mathematical limit. The old model of extracting value from each other can no longer fund the delays in actual operational AI adoption. The headlines misread the stock drop. The market is witnessing the forced birth of a new economic alliance. By every traditional measure, the quarter was exceptional. Revenue grew 6%, earnings 9%, generating $3.6 billion in free cash flow. Then, the stock plummeted 18%, the steepest one-day decline in its public history, wiping out the positive metrics. This repricing was not isolated to one balance sheet. Competitors like Cognizant, Capgemini, and IBM all moved into the red on the exact same day. The market was pricing the impending war of AI delivery, evaluating the sector's long-term structure instead of its recent quarterly success. The answer to what the market sees lies away from the ticker, directly on the operational delivery floor, where enterprise AI is actually procured. This diagram illustrates the current procurement framework, built like a three-legged stool. The first leg is the enterprise client. For years, chief information officers have approved massive spending to acquire AI capabilities, the what, without defining a specific profit and loss target, the why. The second leg consists of the technology vendors. They ship billions of dollars in compute infrastructure and model tokens, but they leave the mechanics of how the client will operationally absorb that technology to someone else. The third leg is the consulting and systems integrator. Their role is to bridge the gap by billing for the how, but they operate on time and materials contracts, charging for hours without taking any financial risk on the final result. 3 distinct parties are involved in every major implementation, yet not a single one is contractually required to own the final business outcome. Everyone observes the data, and everyone runs experiments, but nobody makes the hard decisions or executes at scale, causing the entire procurement structure to fracture. The result is pilot purgatory. Enterprises purchase vast access to AI models, feeding data into humming server farms, but they do it with absolutely zero implementation plan. Independent data confirms the failure. Research from MIT found roughly 95% of enterprise generative AI pilots produce zero measurable impact on profit and loss. Both S&P Global and IBM report similar abandonment rates. The projects do not fail because the models lack capability. They stall because the companies lack integrated data and governance. The leadership across major consulting firms universally acknowledges the necessary destination. The industry must move away from selling hours and transition entirely to outcome-based pricing. Clients are refusing to underwrite endless experimentation. Going forward, the operational result delivered and the compute cost required to achieve it must answer to the exact same financial metric. If linking payment to outcomes is the obvious solution, it raises an immediate question. Why aren't the large public integrators simply flipping the switch? Accounting rules create the friction preventing this shift. Public firms are restricted by recognition standards that do not reward outcome-based models. This chart compares how the two contracts are recognized. Under the traditional time and materials model, an hour billed immediately equals revenue booked. The margin is clean, predictable, and visible within the quarter. In contrast, an outcome-based contract defers revenue until a verified result is achieved. This forces the firm to put its own capital at risk during the delivery phase. Investors focused on quarterly reporting inevitably reject the guidance volatility and lumpy revenue this recognition creates. That specific reporting structure penalty is exactly what erased 18% of the market cap in a single morning. Despite the friction, the migration is already underway. Firms are rewiring operations internally, converting fixed-price contracts one at a time rather than announcing sudden shifts. This aligns with the intent native services architecture proposed by HFS Research. The The client declares their intent, and the provider composes the solution, owning the entire orchestration layer to guarantee the result. Public firms are caught in a vice. On one side, enterprise clients refuse to buy without outcomes. On the other, the investor market punishes the accounting required to deliver them. After the attack on Pearl Harbor, Admiral Isoroku Yamamoto made a clear-eyed assessment of the conflict ahead. He understood the disparity in industrial capacity. He assessed that Japan could run wild for 6 months, but if the war prolonged, they had no expectation of success. This diagram applies that exact dynamic to the consulting industry today. We are inside what we can call the 6-month window, a brief grace period characterized by early victories. The danger is that current financial strength, the deep client relationships and billions in free cash flow, masks a lethal vulnerability. It hides the fact that the firm has not yet built a sustainable business model for the future. That cash generation is merely the runway. It is not the aircraft required to survive once the window closes and the actual war begins. The architecture that wins the war is the AI trifecta: one enterprise client, one technology partner, and one execution team, all bound by a single commercial contract that only pays out when the outcome is verified. This is an operational model already being deployed successfully in heavy industry. PepsiCo partnered with external tech and delivery teams to build physics-based digital twins of their manufacturing plants. By simulating their lines, they increased product throughput by 20% and caught 90% of potential issues before making a single physical change. BMW used a virtual factory environment to collapse their production validation process. What used to require a 4-week cycle was reduced to just 3 days. When a chief financial officer is presented with autonomous safety inspections or a 20% increase in yield, corporate resistance vanishes. The hesitation only exists when they are asked to buy raw compute without a guaranteed result. The true market signal is no longer who can publish the best research paper describing the problem. The signal is who is committing measurable capital and taking actual risk on physical AI. Simple arithmetic is compressing the legacy billable hours model towards zero. As AI automates core tasks, the ability to bill for them at high margins evaporates. For 3 years, the industry has enjoyed the luxury of observing data and orienting strategies. The financial markets have just made the mandate to decide and act entirely mandatory. The opening victory of pilot contracts tells us nothing about the impending war of scaled delivery. The sleeping giant of outcome-based economics is now fully awake.